Economists at TD think another Bank of Canada interest rate is the right way to go at the end of next month. Let's get more from Andrew Hencic, Director and Senior Economist at TD. Thanks very much indeed for joining us.
Thank you for having me.
If you were having a beer with Tiff Macklem and he asked you, should I cut again? You'd say, yeah, that's the way to go.
Yeah, we think so. Given everything that's going on in the economy and the kind of the slack building up in the labor market, we've held the view that two cuts was the way to go. They delivered one in September, so another one here in October, and would take them kind of to the lower end of their neutral range, closer to what we think is a neutral rate, and then they can go from there.
I guess one frustration for the Bank of Canada must be that business, in theory, cutting borrowing costs stimulates businesses to invest, but business capex and investment has been so low.
Yeah, things have obviously been a little tough. The issues with trade with our major trading partner obviously weigh on everything. It's been our view that this will have a prolonged effect. Looking forward, we're thinking of relatively tepid recovery in terms of business investment, but we'll see. What the federal government can accomplish with its budget coming up in November. Are there going to be some measures there? What kind of nation building projects do they intend to put forward, and what kind of financing may or may not be available?
Mm-hmm. You say, though, if you drill into the actual components of Canadian inflation across all core measures has slowed significantly. So even looking broadly at inflation, you say the picture is fairly benign.
Yeah, heading that way. I would say, when you look at some of these measures on a year-on-year basis, things look elevated, but if you look at the last 3 months, particularly across the bank's preferred core measures, and then some of the old classic ones like CPIX or CPI excluding food and energy, things have slowed quite a bit in the past 3 months. The rates are running closer to the lower end of the 2% range. Like I mentioned, we still see that labor market slack is likely to accumulate through the back end of the year, which would take further pressure off prices. As you talked about, business investment here is pretty soft. It could take some time for that to turn around. The impetus to hire and general demand picture is what we expect to be relatively weak and running with leaving the economy with excess capacity, therefore a bit more of a drag on prices going forward. So, that kind of reinforces our view that delivering another cut isn't going to carry that much risk.
Maybe we could put up a 5-year chart for the 10-year Government of Canada bond yield, obviously a crucial determinant of corporate borrowing costs, or maybe the 5-year would be a better proxy. But one of the problems, I guess, for Tiff Macklem is, and he's specifically said this, interest rates aren't a good tool for dealing with disruption from tariffs.
Yeah, absolutely. So the disruptions with tariffs are basically another supply shock, similar, not exactly similar, but comparable to one that we had in 22. These are disruptions in terms of the productive capacity of the economy. Fortunately for TIF, when the federal government removed many of the retaliatory tariffs they placed on the United States, not all, but many, that removed some of that supply shock. So the economy is able to adjust, and the demand side is now suffering. That's where the interest rates can play in, where they can kind of boost domestic demand. On the supply side, that really hinges on how the federal government's going to navigate negotiations with our American counterparts, and what kind of new investments they can unlock and new trade relationships globally they can look to develop.
The economy, there's speculation that we might not get a negative second quarter altogether, GDP. We always put headlines out there, economy in a recession if we get 2 negative quarters. It's kind of an arbitrary thing. But does that have a psychological impact? If we can avoid a second quarter of contraction, could that influence behavior by consumers or businesses?
To a certain extent, it's possible, but I do want to enforce that, the consumer had a pretty good second quarter. If you look at our outlook, we have some give back coming here in the third, just because there was a pop in vehicle sales in Q2 that really lifted things. But, across the board, there was pretty healthy consumption spending in the second quarter. That means that, Q3 2024, Q4 2024, Q2 2025, all very strong consumption growth prints. The first quarter, obviously, with the tariffs and the rhetoric in the trade relationship, things got dented a bit. There is a bit of also a recovery happening in the housing market. Recovery is maybe too strong a word, but sales are picking up a little bit. So there is some positive sentiment happening on the consumer side that is lifting things. So, we're looking for 1%, maybe slightly around 1% growth in the third quarter annualized, avoiding that technical recession. And part of that is reflective of the fact that consumers are spending a little bit better than we thought they would.
Andrew, we better leave it there. Thank you very much. We'll have to take our leave of you. Really appreciate your giving us the time. Andrew Hencic, Director and Senior Economist at TD.